Hang on, baby Jesus, this is gonna get bumpy. This quote by Ricky Bobby, played by Will Ferrel in Talladega Nights, applies aptly to the current state of the job market in certain sectors of the economy. It's no secret that the U.S. economy is slowing down, and as a result of rapid expansion and overhiring, and potentially overpaying workers during the last few years, many of these companies are bloated. They need to slash costs, and unfortunately for workers, the biggest cost for most companies is payroll. In this episode of GAAP Chats, Chris and I talk about the spate of recent layoffs, as well as the related accounting considerations. Welcome to GAAP Chats, the podcast dedicated to all things accounting, brought to you by GAAP Dynamics. I'm your host, Mike Walworth, and with me, as always, is my faithful partner, Chris Brundrett. We hope you'll join us on our journey today as we share our passion for accounting and help change the way you train. You fired.
You can't fire me. I own part of this company, and according to our bylaws, the only way a partner can be removed is for dereliction of duty or gross negligence.
Or being declared mentally incompetent by at least 2 medical doctors.
Don't you think that's more of an issue for you than me?
Yeah, fair point. I'm not firing you. It was just my intro into today's topic, which is layoffs.
Well, there certainly have been a lot of them lately.
Definitely. Here's a list of the companies that have announced layoffs in 2023. And here we are when we're recording this on January 20th. So this is only the first 20 days of 2023.
And we just had one this morning again, right?
Yeah, we definitely did. So Amazon is laying off 2% of its workforce. Salesforce, 10% of its workforce. Vimeo, 11%. Goldman Sachs, 8% of its workforce. Stitch Fix, 20% of its workforce. And as Chris mentioned, fresh off the wires, Coinbase, I think it was last week, just announced an additional 20% reduction in staff, following an 18% reduction already announced in June 2022. That's more than a third of the entire company let go in less than 6 months. And just today, January 20th, on the wires, Google announced it's laying off over 12,000 workers, or 6% of its workforce.
All this in really less than a month of 2023, but that's coming off of the heels of a bunch of layoffs in the fourth quarter of 2022. And we saw Cisco with 5% of their workforce, DoorDash, 6% of their workforce, Redfin, 13% of their workforce, Amazon, again, 1% of their workforce, Meta, AKA Facebook, 13% of their workforce, Twitter. Now, there's a lot of issues going on there, as we all know, but 50% of their workforce, Zillow, 5% of their workforce, and finally, Peloton at 12% of their workforce.
So, I had mentioned Amazon. They already had layoffs in 2022?
Yeah, as you mentioned it, they announced in January 2023 that they're laying off an additional 18,000 employees. Now, those are concentrated in their corporate ranks.
So we're not talking about frontline workers here. I listened to a few podcasts with an NYU professor named Scott Galloway, and he predicted, Chris, that this primarily will be a Patagonia-vested recession. In other words, a white-collar recession affecting people just like you and me. And in honor, I'm wearing my Patagonia vest today.
Back in the 80s, we probably would have called that a members-only recession, but we'll go with Patagonia now in the modern times. That kind of sucks, but these things do happen every once in a while.
Well, I guess on the flip side, it will create buying opportunities, especially in the real estate market, which was smoking hot there for a while. A bit of Schadenfreude as the millennials and Gen Zers who were constantly complaining, and rightly so, that they had been priced out of the real estate market.
Yeah, I mean, things did get crazy, and it was really unfortunate for people, especially first-time home buyers. But, a lot of workers have seen pretty good pay raises and bonuses as we've had this inflated economy leading up to these layoffs. So hopefully there's some money out there in the system to put a chunk of, down to buy a home.
Well, that's assuming, of course, they didn't spend it all on daily Starbucks runs.
Hey, that's a bit unfair.
I know, I kid. But seriously, I think a good life lesson, and it's a lesson my dad taught me, and I know that your dad taught you, is that the key to getting ahead in life is actually just to spend less than you make, full stop. Oh, and don't take out debt except for maybe a house.
What is this, Mike? The Dave Ramsey show?
Okay.
Can we get back to talking about layoffs? That's the whole point of
my bad.
this podcast.
My bad. So, Chris, What is your opinion of the plethora of these recent corporate layoffs?
Well, I mean, this is my opinion. I mean, there's a lot of things that are going on out there, but obviously the big elephant in the room is recession. We've been talking about recession. Are we leading up to a recession? Are we in a recession for the last year or so? And historically, recessions happen every 5 years or so. And as we're in recessions or we're leading up or there's a fear of a recession, companies usually try to get ahead of the curve. And unfortunately, workforce is a huge cost for a lot of companies. And so, that's unfortunately one of the first things that senior management looks at when they're trying to go into a recession already ahead of the curve of having to cut costs. So, this one's been particularly unique just because of the duration. We've got a lot of other complicating factors out there, which I know you're going to talk about one.
Yeah. Yeah. And I think, obviously, layoffs are a necessary evil every once in a while, but personally, I think it's a bit of BS, right? I mean, have you, and it's sad too, and I don't know, you don't use LinkedIn as much as I do, but I was scrolling just yesterday, right, with the Google and then Microsoft. We didn't even talk about Microsoft. They just announced too, Chris. And it is really sad when you hear these people like, hey, I didn't think it would happen, but after 10 years, I've been let go of Microsoft, I've let go of Google, I've let go of Salesforce, and it's just really sad. And personally, I place the blame solely at the feet of the executives who overhired and, in my opinion, overpaid for these workers in that war for talent that was the Great Resignation. And now they're feeling the consequences. I mean, here's what the co-CEO of Salesforce said in a letter to its employees. The environment remains challenging, and our customers are taking a more measured approach to their purchasing decisions. As our revenue accelerated through the pandemic, we hired too many people, leading into this economic downturn we're now facing, and I take full responsibility for that.
Well, I applaud him for taking ownership. Mm-hmm. And sometimes as the chief executive, you have to make tough decisions like that, including letting people go. And, to our sort of point here, I think, this is just while we have recessions every 5 years or so, this has been a particularly unique situation, as you mentioned, and as this CEO mentioned, which is, we had the pandemic, right? So we had people being laid off, as a result of the pandemic, when we were in the depths of the pandemic, and then the Great Resignation that resulted after the pandemic, and then things opened up faster than everybody thought, and there was the great hiring and war of talent, as you called it, and so that's just created a really sort of volatile situation as we're coming into a potential or in a recession.
Yeah, it's interesting. I looked at one of the guys got fired from Microsoft on LinkedIn, and one of the guys, made a comment, keep your head up, dude, whatever. And he's like, I'll bet you the executives didn't take a pay cut. And if we go back to Salesforce, I mean, the dude makes $26 million per year over the last 2 years. And like that commenter said, I doubt he's going to be taking a pay cut. And I think that's my overall problem. It seems the compensation for CEOs and other executives always goes up, regardless of the actual results of the company. The rich keep getting richer in the good old boys club.
Mike, your political transformation since I've known you, which has been 20 plus years, is quite astonishing.
Yeah. Okay. So enough of that. Let's move on to the accounting issues associated with layoffs. First, let me preface this with the fact that we're only going to talk about termination benefits associated with the layoffs in this podcast. We're not going to be getting into the accounting for the related exit costs, such as plant closures, that are often included in an overall restructuring plan.
I like it. Let's focus on a narrow scope. Otherwise, this discussion could drag on. But I do think it is important for people to realize that there's very specific guidance overall for restructuring, exit costs, disposal costs, things like that. And we are just focusing on this narrow subset, which is termination benefits.
And speaking of this narrow subset, if you're all right with it, I think I'm going to limit our discussion today to only U.S. GAAP. If we start talking about differences with U.S. GAAP and IFRS, I think the listener might get a little confused. And so I think we'll just sort of narrow it to U.S. GAAP, and maybe we'll do IFRS on a different podcast.
Okay, that sounds good.
All right. So before we get started, quick question. Why is this an issue? In other words, why do companies wish to show cost as quote unquote restructuring in their income statement?
That's a great question. And entities like being able to classify costs as restructuring because it allows them to isolate those costs and basically clean up their income statement and show improved performance from what we'll call normal operating activities, pulling those restructuring costs into a separate, sort of section. Under US GAAP, you're only able to show costs as restructuring, labeling them as restructuring when very specific conditions are met. So the rules are pretty restrictive, and companies do need to be careful as they go through those rules and make sure they meet all the criteria.
And I'll bet such restructuring charges make their way into the computation of non-GAAP financial measures, which we've discussed in previous podcasts.
You better believe it.
Okay, so under US GAAP, what is the appropriate guidance related to the accounting for termination benefits?
All right. So again, focusing on that narrow subset of restructuring, which is employee termination benefits. Well, before we get into that, let's just back up and talk about the definition of termination benefits so everybody knows what we're talking about. So under US GAAP, termination benefits are benefits provided by an employer to employees in connection with the termination of their employment. They may either be special termination benefits offered only for a short period of time, or contractual benefits required by the terms of a plan only if a specified event such as, plant closing or something of that nature occurs. The accounting for termination benefits depends on whether they fall under Topic 420, and that's exit or disposal cost obligations, or Topic 712, which is a compensation topic dealing with non-retirement post-employment benefits. So to determine which of these topics is relevant and the proper accounting, because I think that's important, 420 and 712 have different accounting guidance. And, this is harder to illustrate in a podcast, but if you go out there and Google this, there's numerous flowcharts that are put out by accounting firms. We have one in our training programs that really sort of show, how to navigate and determine whether you're under 420 or 712. But in words, to determine which topic is relevant in the proper accounting, we need to answer three questions. First of all, is the termination benefit involuntary or voluntary? More on that in a minute. If the termination benefit is involuntary, is it a one-time benefit or is it contractual? Again, more on that in a minute. And finally, if it is a one-time involuntary termination benefit, is the benefit based on past service, or is the employee required to provide future service in order to get the benefit?
Okay, so let's take those three questions kind of one at a time, all right? So the first question is the termination benefit involuntary or voluntary? What is a voluntary termination benefit? I'm assuming nobody wants to be fired.
Well, voluntary termination benefits are considered special termination benefits within the scope of 712. Okay, so this is in that compensation topic, ASC topic 712 that I mentioned earlier. Special termination benefits are benefits offered for a short period of time in exchange for an employee's voluntary termination of service.
Oh, so like when my buddy who I played tennis with, used to work for Altria, he got a special package to retire early at age 59 and a half, and boy, is he living the dream.
Exactly. So we're talking, a great example, as you just mentioned, would be, an offer to retire early, right? So under topic 712, voluntary termination benefits, like an offer to retire early and take up early retirement, like your buddy, they're recognized when the employee accepts the offer and the amount of the benefit can be reasonably estimated. So a severance package, basically, if you took, or a special retirement package if you take early retirement.
But it's voluntary because the company sort of makes the offer and then expects probably a certain take up, and so I have to be able to reasonably estimate it. But the employee has to accept. So my question is, Chris, what if the company makes this offer at year end, and they know that all the employees that were offered this voluntary retirement package will eventually take them up on the offer? I mean, it's sweet. It's a sweet deal. Can they just go ahead and accrue the liability at year end?
No. The key here is that the employee has actually accepted the offer, right? So a company can't book a liability and obviously a corresponding restructuring charge until that formal acceptance has been received. So it's pretty late in the game. The employee has to have already accepted the offer, and we have to be able to make a reasonable estimate of the amount of the benefit.
Okay, got it. Well, that takes care of question one, at least for the voluntary termination benefits. What about involuntary termination benefits?
So now we're moving on to question two, and that is whether the involuntary termination benefits are one-time benefits or contractual. Let's talk about involuntary contractual termination benefits first.
Well, before we do, can you give us an example of such contractual benefits so we can all put it into context?
Sure. Let's say I want to lay off a bunch of people. However, these people are unionized, and their employment agreement states that in the event of termination, they will receive 1 week of pay for every year of service. Because it's part of a union workforce, the company is bound by this agreement. This is an example of an involuntary contractual termination benefit.
That's helpful. How do we account for these involuntary contractual termination benefits?
Okay, this is also under that compensation topic I mentioned, ASC topic 712. Involuntary contractual termination benefits that are given in accordance with the law, could even be just an HR policy that's, stated, or a union contract, as in our example, or even a widely distributed plan that people know is out there. They're under the guidance of Topic 712, as I said, and such benefits are recognized when it is probable that the employees will be entitled to the benefit and the amount of the benefit can be reasonably estimated.
So, whenever we talk about termination benefits, communication gets thrown out a lot. So is it required to formally communicate the benefit to these employees before accruing the liability and recording the associated expense? I'm talking about now these involuntary contractual termination benefits. Is formal communication necessary?
No. So again, just to make sure we're all clear, no for involuntary contractual termination benefits. And the reason why there doesn't have to be this formal communication directly to the employees because it's part of a contract. Presumably the employees will understand the termination benefit to which they're entitled.
Okay, so that leaves us with involuntary one-time termination benefits. And so what was that last question we needed to answer?
So that last question is, are employees required to provide future service to receive the benefit, or is the benefit based on past service? So one-time involuntary termination benefits are accounted for in accordance with Topic 420. So finally, we've moved out of 712, right? Mm-hmm. So one-time benefits, they're not under, some contractual arrangement as we discussed. And so to determine the accounting under 420, again, we have to separate these out and say, well, are the employees required to provide future service? Do they have to work for some period of time in order to get the benefit? Or is the benefit based on their past service, right? We're terminating you on this date. We'll give you X amount based on all of the years of service that you've already provided.
So I'm assuming if future service is required, then the company probably should wait to record the liability and the corresponding expense until the service has actually been provided.
Yes. And one other thing to point out before we get into that is under 420, communication is required. Because these are one-time benefits, sort of special, they wouldn't know about it, right? It's not part of a contract or something like that. So in order to recognize anything, we'll get into some of the other specific criteria in a minute, but formal communication, the employee is required. So back to your question, if the benefit is a one-time benefit and the employee is required to render service for a period of time, they got to work for 3 more months. We're laying you off on March 31st or whatever it is, but you got to work until March 31st in order to get the benefit. So if they're required to work for a period of time, the benefit is initially measured at that communication date when we communicated it to employees, but it's not recognized it is recognized ratably over the period of service. It's not recognized all up front at the communication date. Rather, it's recognized ratably over that service period that they have to provide.
Okay, so that leaves us with these one-time involuntary termination benefits for which future service is not required. And right. I assume that's the case with most of these layoffs.
Well, you know what they say about making assumptions, Mike, but and actually, if you really look at it, a lot of involuntary termination benefits are probably contractual, right? So remember, and that was the first thing, one of the first ones we talked about under 712. And the reason I want to mention this is because we had an example of a union contract. Well, those certainly are common out there in manufacturing and things like that. But HR policy that if there's something stated in the HR policy, hey, if we have to involuntarily terminate you, here's what you can expect to get. That's a contractual benefit that's under 712. So these one-time benefits, this is something that the employee would not have known about. It's not required by law. It's not required by a union contract. It's not required by an HR policy. There can be a one-time add-on benefit to a contractual benefit that makes it more complicated, or there could just be a standalone one-time benefit. But anyway, back to these one-time involuntary benefits. As we said, they're governed by 420, and there's a lot of criteria that have to be met in order for a company to accrue a liability and recognize the expense. And again, to highlight again, future service period, you're going to recognize that expense ratably over the service period. No future service period required, then you'll recognize the liability and the associated expense at the date of communication. Okay. But for either one, this benefit, to recognize the liability and the expense for this benefit, we've got to meet these specific criteria. So here they go. Number one, the plan must be communicated to employees. We already talked about that. Okay. Management, with the relevant authority, commits to a plan of termination. So management has approved it. They have the authority to do so. The termination plan identifies the number of employees to be terminated, the related job classifications or functions and locations of the terminated employees, and the expected completion date. Now, it doesn't necessarily have to get down to such a granular detail that the names of the employees are known at this time, but enough information that we know the number, what job classifications, where, they're located and things like that.
So if I said like 20% of the accounting department at the corporate headquarters in Cupertino or whatever, that would be enough.
Yep. That would be enough, right? You don't have to have each accountant's name yet in order to meet in order to meet these requirements. Number 4, we're on number 4 now. I think the termination plan establishes the terms of the benefit arrangements in sufficient detail to enable employees to determine the type and amount of benefits that they will receive. So the accounting department, hey, they know that 20% of them are going to be laid off. They may not know if it's, which people yet, but all of them can say, hey, well, if it's me, here's approximately, here's what I'll get, right? And the final one, Mike, actions required to complete the plan indicate it's unlikely there'll be significant changes made to the plan or that the plan will be withdrawn. I mean, we're going for it. We're going for this, right?
Wow. So that's quite a very detailed list.
It is. So you're really kind of, pretty far along in this plan before you have the ability to recognize the liability and the associated expense. So the FASB has been very clear that these requirements all must be met in order to recognize a liability for termination benefits.
And I imagine that companies don't always have all these things checked off at year end.
No, as I said, it's pretty late in the game before you really meet these criteria. And it's definitely something that auditors should pay special attention to, making sure that companies really do meet all of these.
So, Chris, you mind if I put you on the spot real quick before we sign off?
No, go for it.
All right. So I'm reading directly from the Wall Street Journal article, today's January 20th Wall Street Journal article about the Google layoffs that I mentioned earlier. Okay. And okay. I want to sort of walk through those 3 questions as a nice summary. So here is what they say. Alphabet said it would offer U.S.-based employees 2 months' notice, plus 16 weeks of severance pay, along with 2 additional weeks for each year an employee being laid off from the nearly 25-year-old company has worked there. In other countries, the companies will follow local processes and laws, which sometimes require consultations with employee representatives before workers are laid off. And so, Chris, if we go back through those 3 questions, I just want to kind of unpack that a little bit.
Sure.
And how we would account for that under U.S. GAAP. So the first question was it involuntary or voluntary, right? And so it's clear to me, I don't need your help with this one. It's clear to me that this is an involuntary termination, right?
Yeah, so, it sounds like it. They don't use that term, but it sure sounds like it.
So, but this question is the termination benefit, so it's involuntary, is it a one-time benefit or is it contractual? What would you, and again, we may not know enough information, but what would you want to look for in that, what I said?
All right. So based on the very limited information that was in this article, I would say looking at the countries outside of the United States, it's leaning towards contractual, because you mentioned that countries outside of the United States, employees affected in countries outside of the United States, are going to follow local laws and regulations. So that's starting to think contractual over there. The U.S., on the other hand,
we don't know enough, right?
We don't know enough.
Was it in their employment agreement?
Right. So is there something in their employment agreement that stipulates this? Is there something in the general HR policy? Is there just a wide practice that they always do this? That can lead to contractual, and that would be ASC topic 712. But maybe, these could be, the non-contractual involuntary benefits that fall under 420. But I will caution you, most don't fall under 420 because there's some sort of a policy or something that dictates. Now,
so it might be. So, for instance, I'm just going to read into it. I don't know anything from the article, right? But let's assume we'll get to the 2 months notice in a minute, because that's an interesting one, I think. But they give 16 weeks of severance plus 2 additional weeks for every year of service. Now, let's assume maybe that they always give the 16 weeks of severance, or maybe assume that they always give the 2 additional weeks for each year of service. Then maybe that's where you sort of said, and we didn't get into it, but you could actually have sort of split benefits, right?
You absolutely could. You can have a situation where, the standard benefit is given. Everybody knows that. It's in the HR policy. We always give, I like the first way you put it. We always give 16 weeks of severance, right? Yeah. But this time, and only this time, we're going to do something extra special, and we're going to give you, whatever it was, 2 additional weeks for every year of service. So you could have a split benefit. You've got the standard one, the 16 weeks.
And that would be a contractual.
That would be under 712, and then this special one-time involuntary benefit under 420. So you can have 2 different standards applying to one sort of termination situation. But again, just to, disclaimer, we don't know enough about, Google here. We're just sort of using this as an illustration. We'll find out when their financial statements come out.
Yeah, that's true. The other thing I wanted to talk about just real quickly, and then we'll wrap it up. They give 2 months notice. That sounds to me like the employees are still working there.
Right.
So that would be that it's an involuntary, maybe involuntary one time, but future service is required. And so I would measure it as of today, but then I would recognize it ratably over that 2 months of service.
Exactly. And that's very common, right? Yeah. You want to give people some notice, maybe, you need them for a period of time, something like that. But, the reverse is true. Sometimes there's terminations and, you walk into work one day and you walk out with a box of stuff, unfortunately. So, but you do have to look at that, right? Because that service requirement changes the expense recognition. That's really important.
Yeah, sorry I sprung that on you. For those listeners, Chris had no idea I was going to tell them.
Well, this is hot off the press, so it's always good to look at an example.
Yeah.
Like
So just in summary, we have a nice blog kind of summarizing the accounting for restructuring charges under U.S. GAAP, and we'll put a link to that in the notes section of the podcast. And if you need further training on the accounting for restructuring provisions under either U.S. GAAP or IFRS, we've got you covered. We have an e-learning course for both GAAPs, and we've also put the related links to these courses in the notes section of the podcast.
All right, Mike. Well, I'm going to say we need to wrap this one up because it has been a long one.
Don't
you say it. I'll take us out. All right, that's all for this episode of GAAP Chats, your source of all things accounting. Notes and resources from today's episode are linked in the description, and as always, you can find us online at gapdynamics.com and at GapDynamics across social media. It's never too late to become a Gapologist. Head over to our website and subscribe to our blog so that you're the first to know what's new with GAAP Dynamics.